3 monitors glow in the sandbagged pit. 2 empty bottles rattle against the ammo crate. 1 open position blinks on the screen, wounded but still breathing. Either it makes it through the night, or I don't. If you're reading this, I probably didn't make it. In my current situation, I'm barely held together. Too damn stubborn to abandon the trench. This is not a trading book. This is a field report. The terrain you'll fight on. The weapons that actually work. The enemies you can't see clearly. Machinery designed to grind you down. It's all documented here. Not because I'm generous, but because the next wave of recruits is being shipped in as we speak, and no one ever tells them where the kill zones are. The rules. Number 1, the market is rigged. Number 2, you are not the customer, you are the ammunition. Number 3, half of what you see is theater. Number 4, survival is not about being right. Number 5, no one is coming to extract you. Skip ahead if you want. The market loves impatient soldiers. It'll churn you up and spit you back out to your miserable mothers with 0 quarter given. If this feels too dark, come back after you've stocked out at the exact price you swore would hold. After your best trade of the year gets front-run by psychopathic algorithms you didn't even know existed. After you've sat in the dark at 4 in the morning, wondering how you're gonna make it through this. Command wants sector assessment, infrastructure integrity, execution capabilities. Document the machinery, they said. You want to know what's out here? Let me tell you what I'm looking at. This is the ground you die on. Pretty charts, not the news headlines, not the motivational horse shit from people who've never held a position through a gap. The raw physics of it. Where liquidity hides, where lies are placed in real time, and where most grunts bleed out before they ever see the enemy. Buckle up, soldier. We're going in. Gonzo out. What is the order book? The order book is the live ledger of all outstanding buy and sell orders for a market. It shows price levels, sizes, and depth on both sides, revealing current liquidity and supply-demand pressure. Traders use it to assess where orders sit, where liquidity hides, and where price is likely to move next. In reality, the order book is enemy intelligence reports streaming in real time, except half the reports are fabricated. It's a flickering wall of truth positions that claims to show you where buyers and sellers are dug in. But half of it is phantom battalions, spoofed defensive lines, ghost divisions that vanish the microsecond you try to engage them. Algos flash massive positions like flares in the night, then yank them before you can call in coordinates. That massive 10,000 contract bid supposedly defending the level. Gone. Evaporated. Never existed. Just 3 grunts with a radio and a box of smoke grenades. You think you're reading enemy positions? You're not. You're reading a deception operation run at light speed by machines that learn psychological warfare before you learn to crawl. The chart tells you what happened. The order book tells you what the enemy wants you to think is about to happen. Big difference. Tactical imperative. Watch for size that persists without moving. It's more likely fake than size that shifts. If you're new here, join the ranks today. Like, comment, subscribe, stay small, stay disciplined, stay operational. Gonzo out. What is depth of market or level 2? Depth of market, DOM, also known as Level 2, data, displays the full order book beyond the best bid and ask, showing multiple price levels with corresponding order sizes on both sides of the market. It reveals liquidity depth, order flow, and where participants are stacking positions throughout the book. In reality, depth of market is thermal imaging for the battlefield, except half of what you're seeing is decoys, and the other half will scatter the second you fire a shot. That massive 50,000 share defensive position holding support. It's a phantom battalion, an algorithmic projection that'll pull out the microsecond you need covering fire. You watch it build for 10 minutes, sandbags stacking, troops digging in. Then Price approaches and they disappear. Those giant cell walls fortified above, half are inflatable tanks designed to make you think twice about advancing. The moment you commit, they deflate and disappear into the mist, never to be seen again. Level 2 doesn't show truth. It shows theater. The real institutional divisions are moving through dark pools, underground tunnels, and supply routes you'll never see. The size on Level 2. That's the decoy camp they set up while the real army maneuvers around your flank. Use it to gauge enemy psychology and spot weak points. But never forget, the professionals aren't watching the puppet show. Building it. Tactical imperative. Use DOM to gauge market psychology, not liquidity. Watch how size responds when price approaches. Real liquidity adjusts position. Fake size vanishes entirely. If you're new here, join the ranks today. Like, comment, subscribe. Stay small, stay disciplined, stay operational. Gonzo out. The bid-ask spread is the difference between the lowest price sellers are willing to accept, ask, and the highest price buyers are willing to pay, bid. It measures liquidity and trading cost. Tight spread equals high liquidity. Wide spread equals low liquidity and higher execution cost. In reality, the bid-ask spread is the minefield you crawl through every time you engage. A toll paid in blood before you even know if your assault will succeed. Tight spread? That's a well-cleared corridor through friendly territory. Clean approach, fast movement. Even a half-competent grunt can slip through without losing a limb. A wide spread? That's a back-alley field hospital in a hot zone. You step in and immediately lose a leg to shrapnel before you fired a single round. The spread is the entry fee for this war, paid in flesh, and you pay it every damn time you cross the line. Tactical imperative. Factor spread cost into position sizing. Wide spreads cut position size in half. Never scale in when spread exceeds 2 times normal width. If you're new here, join the ranks today. Like, comment, subscribe. Stay small, stay disciplined, stay operational. Gonzo out. Tick size is the minimum price increment an asset can move, the smallest possible change in quoted price. Tick size determines the granularity of price movement and affects spread width, execution costs, and scalping viability. In reality, tick size is the smallest tactical adjustment the battlefield allows, the minimum distance between you advanced and you got pinned down in the kill zone. In stocks, it's a penny, barely noticeable individually, but compounded across 10,000 engagements. Suddenly, you're bleeding out in the mud, wondering where all your ammunition went. Futures? Depends on the contract. Some tick sizes make tactical sense. Others were designed by a committee during a bureaucratic meltdown, resulting in measurements so fractured, They require an engineering degree just to understand where you're standing. Forex, down to the 4th decimal place, the pip, which is why currency traders develop combat psychosis and start seeing patterns in coordinates. Why does tick size matter? Because it determines how tight the corridor is and how precisely the market can carve you into bloody tactical confetti. If you think it doesn't matter, you're the poor bastard who loses 40% of his effectiveness to terrain friction and wonders why his brilliant battle plan only works on the map. Tactical imperative. Calculate tick value before trading new instruments. Minimum profit target must exceed 5 ticks to cover friction costs. If you're new here, join the ranks today. Like, comment, subscribe, stay small, stay disciplined, stay operational. Gonzo out. Slippage is the difference between the price you intended to get and the price you actually receive when your order executes. It happens when liquidity is thin, volatility is high, or the market moves faster than your broker can fill you. In reality, slippage is your artillery landing 200 meters from where you called it in, while you scream at command for the coordinates you were promised. You order fire support at 42.10. Clear target, perfect setup. Between calling the strike and impact, the wind shifts, targeting data goes stale, and command collectively decides to screw you sideways. You don't get 42.10. You get whatever cursed grid the shells land on. 42.25, 42.40, maybe worse. Ordnance detonates in the wrong valley while your target walks away whistling. Slippage is the market reminding you that your precious battle plan is just a radio call into chaos. You aim, you fire, the bullet curves mid-flight, and you're left holding the smoking gun, wondering how the hell you missed a target standing directly in front of you. Tactical imperative. Add 0.2 to 0.5% buffer to your stop distance. Slippage eats the difference. If you're new here, join the ranks today. Like, comment, subscribe, stay small, stay disciplined, stay operational. Gonzo out. Liquidity measures how easily an asset can be bought or sold without significantly impacting its price. High liquidity means tight spreads, deep order books, and fast execution with minimal slippage. Low liquidity means wide spreads, thin order books, and difficulty entering or exiting positions without moving the market against you. In reality, liquidity is the promise that reinforcements will arrive when you need them. A promise kept religiously right up until the moment you're actually pinned down and screaming into the radio. High liquidity. Beautiful. Fast deployment, instant support. You can maneuver entire battalions without the enemy even noticing movement. It's smooth, coordinated, almost elegant. Low liquidity. You're wading through a swamp filled with quicksand, burnt-out vehicles, and the corpses of previous units who thought they could just reposition slowly. Every movement alerts the enemy. You try to retreat and realize with dawning horror that you're the only living soul dumb enough to be in this sector. No backup, no air support, no supply lines, no extraction team. Just you and the void staring at each other while your position bleeds out in the mud. Flash crashes, black swans. Liquidity doesn't thin, it vanishes entirely. Reinforcements disappear. Air support goes dark. You're left holding your dick in a position you can't exit without destroying what's left. Liquidity is the market's greatest illusion. Abundant when worthless, absent when critical. Tactical imperative. If you can't exit 2 times your position size instantly without slippage, you're oversized. If you're new here, join the ranks today. Like, comment, subscribe, stay small, stay disciplined, stay operational. Gonzo out. Volume is the total number of shares, contracts, or units traded during a specific period. It measures market activity and participation. High volume indicates strong interest and liquidity. Low volume suggests weak participation and potential difficulty executing trades. Volume provides context for price movement, confirming strength or revealing weakness. In reality, volume is the war cry echoing across the battlefield, the measurement of how many infantry, armor divisions, and unhinged algorithmic killing machines actually showed up to the fight. High volume? It's a full-scale invasion. Buyers and sellers colliding at highway speeds, real capital hemorrhaging through the order book, genuine panic and greed locked in mortal combat, while the tape scrolls past like the world's most expensive casualty report. Low volume. That's 3 cardboard cutouts propped up on a distant ridge, a handful of conscripts with megaphones pretending to be a battalion, while you, the gullible grunt, charge forward alone, the entire army is behind you. Price moves mean nothing without volume. Volume is proof of commitment. It separates legitimate offensives from theater. When price breaks resistance on massive volume, that's confirmation. The assault has weight, substance, thousands of participants crossing the line together in coordinated attack. When price breaks resistance on pathetic volume, that's a trap. One drunk scout stumbled through enemy lines, and you just followed him straight into an ambush. Tactical imperative. Require volume confirmation on breakouts. Price movement without volume is a trap. Wait for sustained participation before entry. If you're new here, join the ranks today. Like, comment, subscribe, stay small, stay disciplined, and for God's sake, stay liquid. Gonzo out. Market microstructure is the study of how trades actually occur. The mechanics behind bids, asks, order flow, liquidity, routing, fills, and the continuous process by which buyers and sellers interact. Price discovery is the outcome, the real-time negotiation of value as competing orders collide, and the market settles on a traded price. In reality, market microstructure is the sweaty, smoke-filled command bunker where the actual war is coordinated. The place no one wants to look because that's where the radios are screaming, the maps are outdated, and the entire chain of command threatens to collapse into friendly fire. This is where price is hammered out on the anvil of panic, greed, and contradictory orders from 6 different generals who aren't on speaking terms. Every tick is a negotiation conducted by 1,000 malfunctioning algorithms shouting contradictory coordinates, while traders slap duct tape on burst communication lines. Price discovery is the final number command coughs up. The grid coordinate everyone pretends represents strategic value, even though it was birthed from a fistfight between an exhausted London intelligence officer and an over-leveraged retail lunatic. Tactical imperative. Accept that price discovery is chaotic. Focus on observable structure, not understanding why. Your thesis doesn't matter to the tape. If you're new here, join the ranks today. Like, comment, subscribe, stay small, stay disciplined, and for God's sake, stay liquid. Gonzo out. Time and sales, otherwise known as the tape, is the raw feed of executed trades, each print showing the exact time, price, and size of every transaction. It reveals the true flow of buying and selling, independent of charts. Tape readers use it to judge momentum, aggression, and the authenticity of moves. In reality, the tape is the battlefield communications intercept, a frantic, arrhythmic stream of enemy radio chatter, firing past your headset like a tactical report from hell itself. Every print is a transmission, a confession, a tiny spark of intelligence from the invisible battalions, buying and dumping with merciless indifference to your survival. To watch the tape is to plug your nervous system directly into the raw feed of combat. No translation, no filtering, no comforting propaganda. Just the uncut transmissions scrolling past like real-time casualty reports. You'll see bursts of size like an armored division rolling through a checkpoint. Ghost signals flickering, phantom bullets, electronic warfare. You'll swear you detect patterns forming, then they dissolve into static, leaving you wondering if the enemy is communicating, or just laughing at your attempts to decode the noise. Time and sales is not a tool. It's a telepathic link to the collective insanity of every broken trader hammering orders across the planet. If charts are the sanitized after-action report, the tape is the screaming coming from the bunker below. Mine including tactical imperative. Watch the tape for size and aggression, not prediction. Large prints at offer equals buying pressure. Large prints at bid equals distribution. Follow, don't forecast. If you're new here, join the ranks today. Like, comment, subscribe. Stay small, stay disciplined, and for God's sake, stay liquid. Gonzo out.